Welcome to Lesson 4, Part 7, which is the final part of this lesson, Building Your Credit Score. In this lesson, we will go over the 5 C's of credit, how to build and fix credit, and secured credit cards. The 5 C's of credit. These are what lenders are looking for. Capacity. The lender wants to know that you have the ability to repay the debt. They want to see your income and how much you owe to other financial institutions to determine your capacity or ability to repay. For example, high capacity is an executive making $250,000 a year with no debts. Low capacity is a person who has been unemployed for 3 years, and in the eye of the lender, no income means no capacity to repay. Capital. This refers to the borrower's net worth or wealth. The lender will be less worried about loaning to a person with a high savings account balance with a few debts rather than to a person with no emergency fund and high debts. For example, high capital is someone who has money in the bank and a few large loans. Low capital or capacity is someone with no money in the bank and a large debt. Conditions. This refers to the state of the economy, national and local, and the availability of money to be lent. If the economy is not doing well, the lender will be less likely to provide credit to a borrower. For example, good economic condition is when the economy is thriving. This may mean that unemployment is low and that people are spending money and the industry is booming. Bad economic condition is when the economy is in a depression or recession. Examples of this would be the 2008 financial crisis and its aftermath, as well as the COVID-19 pandemic, in which we encountered high unemployment rates. Businesses were not spending as much money. One thing to note on conditions, which would be, this is the factor that is least in your control. Collateral is an asset that is pledged against the loan to give the lender more security that the loan will be repaid. The lender is more likely to be confident about getting at least some of the money back when there is collateral. A down payment on a house is collateral for the mortgage the bank gives you. For example, do you remember in the 2008 recession lesson where people were borrowing against their homes to pay off credit cards and got stuck in the loop and lost their homes? Well, they lost their homes because they were not in the position to pay off their credit card debt. So instead, their homes were taken, which is what was their collateral to the bank. Character. Character is the lender's assessment of a person's experience repaying the debt. Those who have failed to repay their debt to other banks or companies will find that their credit is harder to obtain and more expensive. Credit costs more when financial institutions feel that the risk in providing credit is high. The higher the risk assessment, the lower your credit score, and the more you pay and higher interest rates on credit they provide. For example, good character is always paying your bills on time. Bad character is never opening the bills or paying them late, if at all. Building credit. If you have bad credit, don't worry. You can fix bad credit and build it up. It will take some time, but it can be done. The same is true if you have no credit. You can establish credit fairly easily. But again, it will take some time. For this, patience and understanding is required. How to fix bad credit or build from no credit. For both options, you will have to be very careful with your finances. Start by establishing a steady work record and maintaining employment. Opening a checking account is helpful. Having one can help fix or build your credit. Setting up direct deposit from an employer is also a good tip. Make sure that you do not bounce any checks or overdraft your account. Maintaining your account will show the bank that you know how to manage your money by not spending more than what you have. This will make the bank likely to offer you a line of credit. Opening a savings account can positively affect your score. By setting up regular deposits, this will show the bank that you have an understanding on saving money for emergencies and that the future is important to you. Banks are also likely to give someone a credit card if they have a savings account. To build credit, the best way is to start by getting a secured credit card. A secured credit card is a form of credit provided by using your own money. Banks are more receptive to providing a secured credit card if you have an existing account with them, and they see a consistent stream of activity that is in good standing. Approvals happen quite quickly, and it can be done online. Another way to build up from bad credit is you can pay your bills on time. Paying down the balance of your bills is the quickest way to build your credit. If possible, only using your credit card for things you can afford to buy right away. This way, you can immediately pay off the balance with your next check or cash that you have. Get a co-signer on a loan. Paying the loan off as agreed. Trusting your co-signer and no late payments. Applying for restored credit can also be another option. Some credit cards may be beneficial to you, such as Walmart, Amazon, BJ's. Check it out. Secured credit cards. This video will go into depth about what a secured credit card is and how it differs from a regular credit card and a prepaid credit card. Co-signed loans. Co-signed loans can be a hit or miss situation. That is why you have to be very, very careful about who you choose to make this decision with. Not paying back the money you borrowed with someone can ruin the relationship you have with that person and can negatively affect both of your credit scores. While this can be a good option depending on the situation, we don't often recommend it. Congratulations on completing Lesson 4. To get credit for completing this part, please return back to the Google Classroom tab and click where it says Classwork. Make sure to complete Lesson 4 Part 7 Assessment, Building Your Credit Score Google Form. And don't forget to mark as done.